Hey everybody, Chris Englebert with Englebert Financial Advisers in beautiful Allentown, Pennsylvania. It's the 1st of July or the first part of July. And what do we do in the first part of every month? We do our updates as far as strategy and investment review. But as always, I'd like to thank the QCast crew for putting this together with me. Thanks again, guys. Now, what are we going to talk about? You can see I'm talking about what's been happening so far. And I always start out with a little cartoon. And whenever you see a bear, what that means in the investment world is a bear means that prices are going down. We're in a bear market versus a bull, which means we're in a bull market or prices are going up. So we try to add a little levity to it. But the biggest takeaway you can have right now is, thank gosh, the first 6 months of 2022 is over. Any of you that are tuned into the financial news know that the first 6 months was the worst 6 month start to the stock market since 1970. The bond market was even worse than the stock market as far as the first 6 months go. So you can see that in the month of June, we made a low on June 17th. We did have a rally at the end of June, but now we are into July and we're testing that low that we made in June as far as the S&P 500 goes. Now, one of the things that we're trying to have people understand is that if we are in a bear market, which obviously a lot of people believe we are, that some of the best days, weeks, and months come after some of the worst days, weeks, and months in the stock market. So you have to be very careful. After a bad month of June, you could see July or August have a very sharp counter trend rally in the equity markets, especially the S&P 500 and the NASDAQ. Now, some of the things that are happening that are giving us signs that there's more positive price action around the corner is the fact that the 10-year Treasury, which has basically seen yields go straight up since the first of the year, which means obviously bond prices went down. The 10-year Treasury peaked right around 3.5% in the middle of June. And you can see that interest rates have been coming down because inflation fears have been coming down. Now, if you're tuned to the news, you saw that this week there was a headline inflation number that was what they call a 9 handle, or that inflation was running at 9.1%. We're going to go into it in a little bit more detail as far as what makes up that inflation number. But really, what we believe is happening is you're seeing a lot of the inflation fears and prices beginning to peak and roll over. So what that means for the bond market is that the bond market is beginning to see yields come down, bond prices come up. And in fact, in the month of June, the bond market started to recover. So one of the things that we do for our clients is we run portfolios where we have bonds in their portfolio for stability and income, and we have stocks in their portfolio for growth. Well, what happened in the first 6 months of the year is that bonds went down because interest rates were going up very rapidly, and stocks went down as well. So bonds weren't really providing that cushion or that safe haven. But in the last 2.5 weeks, we've seen some stability in the bond market. Why? Because although you see inflation headline numbers out there, you got to understand they're looking back 30, 45, 60 days at prices that go into the inflation numbers that are out there. So I'm showing a chart here where some components of the inflation numbers are rolling over and rolling over sharply. You can see that corn, soybeans, and wheat have all had a major pullback, and they're a component, obviously, of inflation with regards to food. But you can see that oil prices are coming down as well. Those of you that obviously buy gasoline every week have seen that gasoline has dropped as much as 40 cents a gallon in some areas of the country. So again, some of the components that go into inflation are beginning to roll over. We think that's a good sign. We think the bond market's telling us that that's a good sign too. Now, what makes up this consumer price index? And you can see that shelter or housing and rent make up 32% of it. Food makes up about 14% of it, and energy makes up almost 8%. Those three components alone were what were driving those hot inflation numbers. Now, obviously, when interest rates go up, mortgage rates go up as well, and you're hearing in the news the fact that home sales are beginning to decline, home prices are coming down. Whether that's a good thing or not, it remains to be seen. We actually think it's a good thing because we think that in some cases you're seeing housing in certain areas of the country in a real bubble format. But the point that I'm trying to make here is that as housing prices begin to come down in a moderate way, energy prices come down in a moderate way, and food prices come down in a moderate way, you're going to see that headline consumer price number, or that CPI or inflation number, begin to come down as well. Now, what does that mean? Well, let's wrap it up here. The Fed is still projected to raise short-term interest rates by 0.75% the end of July. If you remember, they raised them 0.75% at their last meeting. We still believe they're on target to raise them 0.75% in July, 0.5% probably in September sometime, and then they're going to pause to wait to see what happens. So the good news is that short-term interest rates are going up. So if you want to invest some of your money, if you're really scared about what's going on out there, you can buy a bank CD right now for 2%, 2.25% for 3-4 months. Not a bad idea. But if you see, what I'm talking about in my second bullet point is that we are now in the midst of second quarter earnings. And we believe that second quarter earnings are going to be better than what people realize out there because the economy is still strong. Employment is still strong as well. Interest rates have been stabilizing. That's helped the bond market. And we are in total belief that the stock market right now is pricing in a severe to moderate recession. The stock market's also pricing in at least a 10% earnings reduction. All of these factors we don't believe are going to happen in 2022. And at any time, you could have an extremely sharp counter trend rally in the equity markets because the amount of bearishness, and I've talked about this before, the sentiment out there is so negative at this point in time that there are a tremendous amount of people sitting on cash. And when the stock market turns around and starts to rally 5, 10, even 15% would not be unusual. Those people will finally throw in the towel and say, hey, listen, I got to get back invested in the stock market. So although the first 6 months of the year were extremely tough as far as equity and bond markets go, just to sum it up, we're seeing a turn in the bond markets. We're seeing the equity markets still have a volatile period of time, but you got to be careful because any of these particularly sharp sell-offs can be followed by a particularly sharp rally, and we could see better times ahead in the next 3 to 5 months. So that's all we got for this week, first of the month update. Thanks much, and we'll talk to you soon.